Hi, everyone. Welcome back to Wade into Wealth. We are marching our way through the month of May, and that means we are inching closer to May 20th, which is when we want to remind you is our annual Shred Day at the Rochester office from 1 to 4 p.m. That's in the afternoon. Shred that right up. Don't need it.
Nope.
We should also mention that we're back in full high definition.
Although I may need
video.
that.
You may need
that was our outline, but that's okay.
That's okay.
It is our most popular.
Yep.
I think it's our most popular event, and it has free in the Rochester office has free ice cream.
Yeah, who doesn't love that?
Get rid of your sensitive documents. Have free ice cream, and you don't have to be clients.
Nope.
Bring coworkers, friends, neighbors, whomever.
Your
Just
pets.
Don't forget.
Don't
forget
shred your pets, though.
Don't shred your pets, and don't forget your documents.
Right. Bring your documents.
Mm-hmm.
They can. Yeah, anything you have, if you think it, or, don't hesitate to give us a call or email and ask, I've got these documents. Should I keep them? That's a fairly common one. How many years of tax returns should I be holding on to? Because we have folks that have them from into the 80s or 90s.
Well,
you don't need to hold on to them for that long.
I'm going to ask you. I don't know. I think maybe Dave Maniosi, our CPA, maybe 7 or 8 years, but don't quote me on it.
No.
I don't know the definitive number of years you should keep.
Well, this is why you ask.
Yep.
And so we can ask and find out.
That's right. Don't ask us.
So Shred Day, May 20th from 1 to 4 in the afternoon. That's at 1703 Monroe Avenue here in the lovely town of Brighton, 14618.
Mm-hmm.
On to some news that may be a bit more gloomy, if you will, and that is the stock market, which has been quite turbulent, choppy. I hear the word volatile a lot. I don't tend to use that word just because I hear it so much. I get tired of using it, but it's been a little choppy lately. It's been a tough market.
Up and down.
Yeah, we're recording this on Friday afternoon, so we don't
A little
know
bit more down.
happened on Monday or Tuesday of next week. But yesterday, which was Thursday, May 5th, all the major market indices down significantly. The S&P 500 down 4%. The worst day for the indices since 2020. Not a great day. And that comes on the heels of what was a very good day. The Dow was up 900 points on the news that the Federal Reserve plans to continue with their interest rate increases in the neighborhood of about 0.5%, which that's the biggest jump since
2000.
2000.
Yeah,
right.
It's
So in 22 years, that's a big jump. And we're in an environment now where I just looked, the average 30-year mortgage rates over 5.25%.
Yeah.
As high as the last time it was that high was 2009.
Interest rates are likely to continue to go up.
Yeah.
Bank savings not likely to go up meaningfully.
Nearly as much. No. So we're swimming in a pool right now where the water is a different temperature than it's been.
It is. And we think to what 2 years ago was like, and we have a couple days. Wednesday, May 4th, the Dow Jones was up almost 1,000 points.
Yep.
Thursday, May 5th, the Dow Jones was down more than 1,000 points, and that was, if we go back to March of 2020, that was almost a daily occurrence for the better part of what felt like a daily occurrence for weeks.
The third week of March was a pretty rough week. We had multiple days where there were drops over 1,000 points at that point in time. Some perspective, though, if you will. I think that's something we can do well from time to time here. If we consider percentages instead of the number itself, yesterday or Thursday's drop doesn't even crack the top 20 in terms of the worst days in the market, because percentages allows us to make more of an appropriate comparison. Because 1,000-point drop when the Dow Jones is starting at 33,000 is different than 1,000-point drop when the Dow's at 9,000.
Of course, yeah.
So percentages will give us a more honest picture. It's still not great. You still notice it.
Yep.
But perspective always helps.
And what we know, there's a good example from 2008 that if you had just stayed invested and didn't abandon the ship, you made 100% of your money back if you were invested in the index in 2 years. If you missed just the first 30 days, I believe it's only 50% return over that time. If you miss the first 60 days, it drops down to probably 30 to 35. And if you miss the first 90 days, just the first 3 months of the recovery, you probably only made back a quarter of the money that you had given up. And the point there is not to try to time the market. It's that no one will know when the market will hit its bottom. But what we do know is that once it has hit its bottom, in order for you to make back the paper losses that you have incurred, you have to be invested, because some of those best days come shortly after the worst days. And if you miss those best days, you will also miss your chance to make back the money that you've given up.
Very likely. Historically speaking, the most important days of market recoveries after recessions and significant dips in the market have come within 14 days of the market hitting its bottom.
Yeah. We don't know when the bottom is.
Right.
Look at that.
Look at that. Well, that's the caveat you have to make, is that we don't know when it is. But that is why we try to do several things.
Right.
Own a diversified portfolio of investments. Own investments that are of good quality. By good quality, we mean companies that are not necessarily speculative. Talk about right now, what are some kinds of investments that you would consider speculative?
Bitcoin.
Okay, cryptocurrency is one.
Marijuana companies.
Cannabis companies, that's another one. Penny stocks in general.
Mm-hmm.
If something's trading for less than $1 a share, there's a reason. There's likely a reason.
I mean, even less than 5. Yeah.
Correct.
Yeah.
Right. So those are examples of speculative investments. I would add in another category of what I would call a speculative investment is where there's more than one layer of things that need to go right for the investment to work. Where, I'll give you an example. I've seen them before where you say, well, this company is expecting a court decision to be made. There's a ruling they're expected. And if that happens, then it's going to skyrocket. Well, that to me, that's a speculative investment.
Well, sure.
You're
betting on an event happening.
Right.
Yeah.
That is outside of your control, obviously, but also that's outside of the control of the company itself.
Mm-hmm. Yep.
When you're looking at investments, you want to look at, I would say first and foremost, is this a company that makes or sells a good or product or service that people know and use?
Yeah.
Do they pay a dividend? How have they performed in previous periods of a recession or market downturns?
And does it seem like it has a lot of sizzle to it?
Right.
Because often the most quality investments are going to have very little sizzle and they're going to be very boring.
Right. When's the last time somebody talked about it on CNBC?
Right. Yeah.
I would prefer to be as far away from that as possible
Yep.
when looking for companies to invest in. Very rarely are companies that have consistently risen their dividends talked about as a hot buy.
Yeah. And the reality is, if you're in retirement and you're taking distributions out of your account, you should have some cash set aside on the sidelines in that account to cover a period of your monthly distributions so that you don't have to sell your equity investments, your stock investments, when we have a downturn in the market like this. And I had a client ask the other day, well, if the market goes down a lot, do we have to alter our distributions? Well, possibly, but not definitively, because you want to be proactive in the fact that you don't want to time the market, but you want to go into your retirement, knowing that there will be bad times. There will be challenging times. And so keep some cash on the sidelines. If you know that you're taking out $3,000 a month from your account, well, maybe you're keeping $18,000 to $20,000 on the sidelines. Maybe you're keeping a full year's worth, $35,000, $36,000 technically, on the sidelines, so that when we have a challenging market, you can look at it and say, well, the money we're taking out of this account for the next 6, 12, 18 months isn't even at risk. It's on the sidelines, and we have access to it.
Right.
And while it won't make you anything on the sidelines, it won't go down.
No.
But if that prevents you from abandoning the ship for your stock investments when the tide changes and the storm comes, it's worth itself in spades.
Absolutely. There is also a real case to be made for this is why, if you are taking distributions from your investments, it's important to make sure you're taking an amount that is reasonable.
Yes.
And by reasonable meaning, look, it's fine. When the market's going up, if the market's up 20% and you're taking out 8 or 9% of your investments, Well, that's that you don't notice that. That masks a problem.
Right.
That hides an issue. But when it becomes an issue is when things drop. And all of a sudden now you're saying, well, my investments are down. What's going on? And the answer often is, well, you're withdrawing an amount that's not sustainable.
Yep.
That issue's masked when things are going well. When things are not going well, you can really start to feel it, because if your investments are down 10, 11, 12% and you're taking out another 8, well, even I, who is not great with math on the spot, if you're down 12 and you're taking out 8 at the end of the year, you're down 20.
Right.
And
and you're just creating a bigger problem.
That's where it becomes really problematic. So
because
moderation,
then you're going to have to sell investments.
Right.
You're going to have to sell investments at prices and valuations that perhaps you otherwise wouldn't want to if you had your way and you had your choice, which meant less money and less capital to be able to rebound.
Well, right, because then that's when you start to rethink your withdrawal strategy. Then is okay. Well, I've been saying maybe I shouldn't take as much, but now I can see why this is a problem. So now you're having to think about, well, do I need to alter my lifestyle? Mm-hmm. Because if you're withdrawing that much, in most cases you're not just saving it at the bank. It's usually being spent.
Likely.
So
very likely.
Those things are important to consider. So.
Best advice we can give: spend less than you make.
That's a good one. It's
the best one.
Oh.
It has nothing to do with stocks, bonds, mutual funds, ETFs. Yeah. Spend less than you make. If you do that, when you go through these challenging times in the markets, your portfolio is going to be able to hold up fine.
There's a big difference between saving and not spending.
Correct.
Not spending is the easier of the two. That we are in control of.
Mm-hmm.
So let's end with what's causing all of this? Because we talked about some things. I mean, obviously, the fact that interest rates are quite high is one thing, but that's not the only. It's not the only thing. I'm assuming you filled your car up with gas lately.
Yeah, it's uncertainty.
Yeah,
it's always uncertainty. Your favorite word. What creates volatility in the marketplace or the markets is always uncertainty. What's always different is the cause of that uncertainty.
Yeah,
interest rates. We didn't know how much the Federal Reserve is going to raise them and by how many times they will do that this year. What's going on between Ukraine and Russia? No one knows what that end game will look like.
Right.
And that also creates further issues for our supply chain, because the Federal Reserve is trying to bring inflation down by dampening demand, and their method for doing that is by raising interest rates. I would argue, you would probably agree, one of the biggest causes to inflation right now and prices being higher isn't on the demand side.
It's the supply.
It's more on the supply side. Right. So what's going on between Ukraine and Russia, major exporters of wheat, even probably larger exporters of fertilizer and fertilizer inputs used by farmers around the world, is going to create more issues on the supply side. So the Federal Reserve will do what they can do and attempt to do it, but they can only impact one half of that equation, which means we're likely to see inflation still. We're likely to see them increase interest rates more. So there's uncertainty there.
Yeah.
And we're also in a midterm election year.
Yep.
Which is kind of being overshadowed in certain ways, I guess, unless you're really focused on that, with other current events that are going on in the world, because that election's not happening for a couple more months. Yeah. But any time that there is uncertainty in the markets, you're going to see the fluctuations and you're going to see the ups and downs.
Yeah. And the supply and demand's out of whack.
It has been.
Things
it
that
will
there
continue
is,
to be.
that there is demand for, there is very little supply of. And what there is now supply of, the demand has weakened. Hand sanitizer. We remember a time not too long ago, you couldn't find hand sanitizer.
COVID tests.
Well, the demand for hand sanitizer is down 50%.
Yeah.
We did a podcast where we talked about ketchup packets.
Yep.
Because people are, we're doing takeout. Well, do you need ketchup packets now? Not necessarily. People are going back out to restaurants. People are returning to pre-pandemic ways almost entirely. And
but you almost can't find baby formula. Yeah. Which is frightening.
Yes. That's
that is a real concern when you go to the shelves and you see that there's almost no baby formula.
Yeah, that's a serious one.
It is scary.
It's a serious one. So, supply and demand is really what's driving it. Jerome Powell, the chairman of the Federal Reserve, said he thinks there is a good chance that what the Federal Reserve is doing could lead to a soft or soft-ish landing. I don't know how much confidence that instills.
I mean,
but
I hope
would
that's
think,
the case.
I hope that's the
who
case.
knows?
But if you think about that, I mean, we've been on an airplane before where there's turbulence. Everything's okay in the end, but there are periods there where you're like, oh, what's happening?
And it also wouldn't be the first time that our economy has gone into a recession.
No.
It wouldn't be the first time.
Nor will it be the last.
Nor will it be the last. And the reality is, you go back to 1975, the S&P was at 100. Today, it's north of 4,000.
Right.
And there have been plenty of geopolitical issues in that time. There have been recessions in that time. There have been market crashes. There have been wars, multiple wars. 100 to 4,000.
It's a good return if you stayed with it.
If you stayed with it, which was the hardest choice. But we mentioned a couple podcasts ago, your favorite word, volatility, is the price you pay for superior returns.
And that's where we'll end it. This is Wade into Wealth. Back with more next week.